Hello everyone, and thanks for watching Aeropedia World Videos. In today's session, we'll start with security analysis and portfolio management. But before going to securities, I would like to discuss about investment. Why we need investment? What is investment? Who are investors? And why they invest? These are few fundamental questions that we need to understand before understanding the tools of investment, that is securities or various avenues of investment. Now, every branch of knowledge has its own contribution, which has been or which became the turning point in the history of mankind. Like in mechanics, when you say it's wheels, in politics you can say it's votes. Similarly, in economics, the credit goes to money. So before understanding anything, we need to understand money. Why we keep money? What is the reason because of which we keep money? So normally there are three motives because of which the money is kept. So those three motives are transaction motive, precautionary motive, and speculative motive. So what we actually mean by transaction motive? Transaction motive is basically demand for money for current transaction of a person. Now suppose you are going to purchase something from the market, you need money, and that transaction can be a cause why you are keeping money. Another motive that we have written here is precautionary motive. So precautionary motive is like whenever you are driving a vehicle and maybe you get down to somewhere, you keep some money with you in order to, if you met with an accident or your car broke, so might be your engine breaks. So in order to avoid these situations, or not to avoid, in order to mend those things, or in order to rectify the problem at that point of time, you need to keep money in order to get the service. So that's why you keep money, and this can be the another motive, that is precautionary motive. And the third one is speculative motive. Here the motive of keeping money is to take the advantage of the market price movement of a particular good or or maybe a rate of interest, so on that you can earn because of the fluctuation in the price. Now apart from that amount which we have kept for our transaction or as a precaution or as a speculative motive, so I can say the amount that you consume out of total money that you have, you keep some money as a saving. So the total money that you get out of which you consume something and you save something. So out of the saving, rather out of money that you have earned, there is a part that you save, and that part is basically affected by a term called inflation, or maybe because of the idle asset situation, that saving might be a cost to you. So saving, unless and until it is invested, has no meaning. So saving needs to be invested. So we came to the conclusion that saving needs to be invested, but the reason is because it is affected by time value of money. I hope that students are already aware about the time value of money. In a brief sentence, I can say that the value of money changes when you compare the same amount of money in two different time, or you can say inter frame or inter time comparison of time, rather money is not possible, so they need to be adjusted because of the time value of money. The saving gets affected. In order to avoid that effect, we need to invest the saving at a certain rate of interest or a certain rate of return, so that it can offset the loss or depreciation caused by the inflation rate, which can be a cause of depreciation for the saving, or maybe the required rate of return. So here we come to the term investment. Now, what does term investment actually means? It is the time, money, or matter spent in order to get some future benefit actualized within a particular date or a time frame. Now, both economics and finance defines investment in a different way. So first of all, we'll write it here that investment is time, energy, or matter spent in hope of future benefit. And actualized within a time frame. Now, as we said, both economics and investment finance defines investment in two different ways. So in economics, investment is accumulation of newly reduced physical entities. While finance defines it as a process of putting money in some asset expecting future in future capital appreciation or maybe dividend or rate of interest or interest. So both the definitions are different, although we will be using the definition of finance because this is what we require in order to understand our concepts of security analysis and portfolio management. And another way which we can use to define this investment in a broader sense can be like sacrifice of current money or maybe other resources, I am not writing it here, for future benefit. So this is how we define investment in finance. Hope this video helps you. and thank you for watching this video.